professor in a website? I created one for our startup using Wix. Let me show you how I did it. First, go to Wix.com. Our startup is constantly evolving, and we need a website that can...
Trade on pound yen, and that's the only thing I focus on. Because I think if I can focus on just one pair, I'm not gonna say it. Well, I think before the you ain't got no at this point. I wonder who has already taken 2 trades and don't hold that against me. You can see gold moving back up.
It's gonna be the push that we need for change to break down. Yeah.
Perfect timing.
Yeah. Oh shit! Looks like everyone went over here. What was the news of it?
Perfect timing.
Holy 10 pip spreads, 5 pip spreads on pound. See, when price is moving super fast, this is where you don't want to enter trades. You want to stay calm. You want to stay calm and collected. See this buy stop, price never really came down to it, so didn't really activate it, nothing at all. Right. So what was the news event over here?
Really point this summer, and then of course what happened in the Capitol, Mello.
Definitely.
Good morning, everyone. Good morning, everyone. Welcome to Hedgeye Nation. This is Darius Dale, Senior Analyst of the Hedgeye Macro Team. I'm joined in the studio today with Hedgeye's founder and CEO, Keith McCullough, to welcome you to another episode of the Macro Show for January 7th, 2021. We have a special show for you guys. We thank you for tuning in. For those of you who are new, we obviously have a freemium show today. Hopefully some Twitter trolls can join us and learn something this morning. But we also, it's a big day today at Hedgeye in general. We have our Q1 2021 macro themes presentation at 11 Eastern. Macro Pro subs obviously get that. Obviously, we'll be on the horn and institutional clients all day and all next week, just going through those slides. So we look forward to that. And with that, I'll turn it over to Keith.
Thank you, Darius. And that is indeed the most important, I'd say, fulcrum point of research at Hedgeye. It's the quarterly macro themes call. So that's what people pay the big bucks for. That's at 11 o'clock. If you want to access it, support at hedgeye.com. Darius has been cranking. I don't think he's slept more than 3 hours in the last couple nights, and that's a tribute to his work ethic, but also the depth and breadth of that deck. Now, it's probably like 110 or 120 slides deep is what that deck is. And what we'll do every day thereafter, after we reveal all that, is just update it. Don't forget that most of what we do is just absolutely data-driven, so it's just updating the data. So again, we'll go through some of that this morning after I get through the top 3 things. We also have Neil Howe, who's the best demographer on the bloody planet, after they storm the Capitol. And isn't it amazing that that's not, like, top 3 things, guys, this morning? I think I'm starting with Asia this morning. I'm going to do the bond market and tech. I'm not going to go with Pelosi, selfies in her office, Georgia, and whatever the hell else they're talking about on Old Wall TV. All right, again, check your politics at the door. If you don't want to, you can try to trade on them. You're going to fail miserably across cycles doing that. Again, we'll stick to the data. Number 1 this morning is Asia. So what did they really think about storming the Pelosi office or whatever the hell it was? And again, I'm not trying to do disrespect to the people that actually lost their lives. It's sad and pathetic. But what happened in Asia was we don't give a shit. You know, that's a technical term for the market going straight up into the right. So whether it was Japan, which we continued to be long, up another 1.6% overnight, making, again, pretty close to a new cycle high. Don't forget, you had the last 2 to 3 days I've been telling people that pay for this to be buying Japan on the bloody dip. That's what you do in Quad 2. And it's Quad 2 globally. Another market that we continue to like that just ripped the faces off the shorts is South Korea. People are like, oh, look at the chart. I got to short it on the on Georgia? Really? Green lights. See that? Look at that. Like, that was up 2.1%, and it's not like it's kind of gone up a little bit in the last month. It's up 10.5% in the last month, and that's inclusive of the 2.1% gain. So again, China hits a new cycle high, South Korea, you got Taiwan, which we've been buying since June. All this, by the way, are full cycle investors. I get accused sometimes of not having all the green lights, not being a value investor, a hodler, a maxi. But what I really am, stick this in your notebooks if you have one, is a full cycle investor. Now, full cycle investors understand the difference between interest rates falling and rising, because if you get the cycle right, you get the dollar right, you get rates right, and you get big stuff. Look at this. Let's do the 10-year yield. You get that right, okay? Full cycle investors have been buying commodities and emerging markets, by the way, since June. That's when we started shorting the dollar. The 10-year yield, we just started shorting back in November. So we waited on it a little bit. Why? Because there were some yellow lights. And actually, back in September, there were red lights, right? Because we had some quad 4 to quad 3 action. But since November, it has been green lights. Right? You can go to Texas, you can go to Tallahassee, where the hell you want to go. But it's quad 2 this morning. It's quad 2 in the bond market. It's quad 2 in the foreign currency market. It's quad 2 in the equity market. The Russell 2000 was up 4% yesterday, bro. 4%. That's a new all-time high. That's called going vertical. Green lights. You see that? Have you read the book yet? You know, Matthew McConaughey, beautiful Irishman, you know? And I go both ways. I'm okay saying that. I go both long and short of the gold. Look at that. What's the inverse? Now, so Darius, you see how that line starts like 5 months ago? They're like, oh, you cherry picker. Cherry picking? Cherry picking, that's a red light. Yep. That is back in August. Now, go back. So the top of gold is 2,100, all right? That's the top. All it's done is made lower highs since. If you bought the top, you're down 9% from there. You got to be up over 10% to get back to the break even. You're having a drawdown. Drawdown's a red light for those of you that ever lost money. All right, so again, flip that back to the 10-year yield. See how the 10-year yield bottomed when that gold chart topped? See that? That's not a magic trick, right? This doesn't have to do with your belief systems or your dogmas or your visceral whatevers. It doesn't have to do with anything that I've triggered so far if you're not a paying subscriber but is watching this. Yeah, it's just getting the cycle right. If you get the cycle right, you won't have to have all these bullshit debates about value versus growth. We're long value and growth. Imagine that. Green lights. Tech, now tech gave you an opportunity yesterday. So the narrative goes that you sell tech because interest rates are going up. Wrong. You know, when we called the breakout in interest rates, whether it was in 2013, 2017, or this year, you buy tech. You know, if you've been selling tech on dips to the low end of the risk range, which is precisely where you buy it, especially if there's a big fat implied volatility premium, show that. Look at all the green lights on this one. Look at this. How many people that are watching this for the first time even know what the hell that says? Oh my God, those are too many numbers. I got to go back to watch what Chuck's going to say today about Nancy. Like, good God. I mean, help yourself. I mean, 92% is the implied volatility premium on XLK. First column up there in the top right corner where Grandma keeps the cookies. Green lights. Yeah, it's good. Right? So when something gets low to the range and it develops a big fat implied volatility premium, you buy it. Right? That's how you do it. You don't need to know anything else. Nope. And we'll go through, actually, if you want more, we'll go through this cycle of earnings that's about to rip people's faces off, GDP fully loaded in inflation, which we have going to 3.08% by Q2. 3.08. That's specifically 3.06 yesterday. It went to 3.08 because commodities are going up again today. Can you show it one more time? It's all embedded in the top three things. But commodities, from where we bought it, up 42% for full cycle long-term investors, you dirty little traders, you. Yeah, look at that. Green lights. All right, top three things. That's what we got. Right. We do that every morning. Trying to get Neil Howe to chuckle a little bit. Neil Howe, one of the great professors, really, of teaching people about I've been talking about super long cycle demographics. That's some of the only certainties you're going to have in macro. Is that, you know, there are deaths and there are mortalities associated with deaths because it's one and the same thing. There are births. You know, that's going to happen. What is harder to get is what I cited this morning. My old professor, Darius and I, both Yale students, some of the smartest people you've ever met, huh? Actually, I had the lowest SAT score at Yale, but this is the one class that I didn't get a B- in. This was a B+ I got from Schiller. And he wrote this great book called Narrative Economics. So what I just want you to remember is that the daily dose of Wall Street talking points has a lot to do with narrative, right? It has to do with already happened looking backwards. What we're trying to do is get you to where we're going to be in 3 to 6 months. That's it. and understand within the long-term cycle what those 3 to 6 months are going to be. So again, you write it down. When we have 3% inflation, it'll be breaking news 3 to 6 months from now when those numbers hit. But you're already positioned for that for a full year, right? We bought inflation commodities in June of 2020. Okay, so that's how you take advantage of it. You front run it. You front run it. That's a good thing to do. All right. Now, what we do throughout the rest of the top 15 minutes or whatever I have is we write down the risk range. So again, what you don't want to be is the uninformed volume. You know, commonly called an idiot when I'm an idiot. When you buy something at the top end of the range, that's just not good. If you sell something at the low end of the range, not good. No. If you sold on Monday based on the blue wave fear or whatever the hell you chased gold that day on, no. You bought gold at the top end of the range and then you got impaled yesterday. You don't want to do that over time. No, that's embarrassing, especially if you're me, because I bloody well timestamp every position. I'm the only one dumb enough to try to do that.
Thank God, man. We appreciate you.
Holy shit. We're talking about some progress here. Learning, 3680. So this is called a higher low. When you have higher lows and higher highs, you buy the damn dip, okay? Especially if the quad says that that's what you should buy. Now, even if the quad didn't say that, I'd still do that. You know, so this is 3776, okay? That's not the next year that they stormed the Capitol, all right? That's a higher all-time high. And as we like to say in historical terms, for those of you that are history students, you may not be as mathematically inclined, all-time is a very long time. Okay, so that's what you want to be positioned for, all-time highs in the S&P 500. The corollary to that is, of course, how we model it, which is price volume volatility. So I think that the VIX is going to go back towards 20. And it might just start to happen as soon as pump's gone. Actually, I downgraded him to Donald. You know, he doesn't really have market impact like you said, a little bit yesterday, intraday, but from the top end of the range, don't forget. So I don't want to give Donald all that credit, right? So again, understand that the game changes. And if you don't change with it, that's going to be your problem. All right, let's just dig into it a little bit more. What happened yesterday on the up move? We had back-to-back up days off the oversold signal from the day before. We, of course, had volume doing what? So if you look at the volume, don't forget the volume matters. If you've never tried this like in a body of water, try putting your kids on a raft in a river. Now, if you're not going to pay attention to the speed and the rocks of the water, you just look at the surface area because you were taught on Wall Street to watch moving monkeys in the forests. Don't worry about your children or the rocks or the speed, the volume, the volatility of the water. No. Look at the simple moving monkeys in the trees. Do we feel safe? Holy shit, some of you. I mean, really. Really. Think about this. Just try. Does the 50-day bloody moving monkey give you solace when you bought gold in the first week of November when it spiked to the top end of the risk range? You don't do that, do you? Triggered? Volume up 8% versus the 1 month average. What else did we have going on yesterday? Look at the bongo board, or the sectors. Big buying opportunity. It was actually a pretty broad-based rally. We got paid on, we're long industrials, financials, energy, tech. And I bought the shit out of tech yesterday because it was at the low end of the range. I was buying it right into the close. I even bought myself some apples too. Apple, the stock, right? That's a PA idea if you're looking for picks. How about that? Really contrarian thought, buying Apple. Actually, the contrarian thought is buying Apple when it's the low end of the range, when the uninformed volume is freaking out because people are stealing Nancy's chair. Yeah. What else we got going on? Look at cross asset class volatility. So for those of you that don't even look at volatility, it might be a little harder on the eyes to look at this because this is way too much data. So what was happening when they were doing the whole protest thing? High yield spreads were falling. That's bullish for quad 2. We still have a bullish regime of volatility in the MOVE index, which is treasury bond volatility, which is very bearish for treasuries. So again, covering some treasuries at the low end of the range, we have no problem with that. We remain short of treasuries. I have really no pushback on short treasuries. I get a lot of pushback on short gold, even though that's pretty much the same thing. We're talking about across the full investing cycle, not day to day. We have some people who are like, well, I don't believe in the daily moves. I'm a strategist. I'm a longer term guy. That's just stupid shit, right? You only hear that shit on Twitter. But the reality is that we have a moving, when the move is moving higher, that's treasury bond volatility, you short the bonds, okay? And if that continues and we continue to get higher highs and higher lows in the 10-year yield, gold's going to continue to make a series of lower cycle highs from the cycle peak. Write all that down. All mathematical words indeed. We're not trying to derive anything else other than the rates of change. Asia last night, already hit on that. Europe this morning continues to look better and better. Look at Germany, which was one of the last countries to go from quad 4 into quad 2, if you want to know what this. So that's called a higher high. And that I'm only drawing the green arrow there because Germany only went bullish trend on our signal from there. Okay, so for those of you that see me tweeting charts, it's not just like some bozo that, well, I'm a bozo, right? But not really. Okay, it starts from where we started. Yeah, that's where it says cover the German short, which we were short all the way into. It was a great short, actually, as you can see and throughout October. And then we covered it, and now I'd be buying the damn dips in Germany too. Look at the quad data. If you want to look at slide 20, Darius has updated this for all the global economic data. This is only the G20 on slide 20. Okay, so a little bit of a magic trick for you there. See how the column there that, like, if you take my face off here, just go to the data, guys. Come on, people don't want to see me. Look at that. See in Q1 of 2021, every freaking country in the G20 has a 2 in front of it. 20 has a 2. Each quad is a 2. What are you doing? Trading Georgia. What are you doing?
Well, you would trade Georgia if you didn't know that the entire world was transitioning to Quad 2, let alone not even know what a quad actually is.
This is interesting. Yeah. Yes, Neil Howe is going to have some thoughts on that. Imagine just being completely macro unaware.
Oh, boy.
You didn't know where the cycle was, the quad. You don't know where Neil Howe is. You don't know anything, really, but you got your 50-day moving monkey in the tree. Yeah, that's feeling pretty good. Gold immediate term downside 1846. Yes, I will short it again, but not here. 1955 would be a perfect spot to short some more gold, which I did the day before that. So again, that's the top end of the range, a big lower high. Copper, don't buy it here. We buy it on dips. Corn's dipping. It didn't dip quite to the place where I would particularly execute. What I did execute yesterday on was buying some coffee. Imagine that. Bought some apple and some coffee. JO is the ticker on that because it did hit the low end of the range. I've been saying this since June. I'll say it again. And I do think of Bitcoin as a commodity. Please don't cancel, right? If you don't like commodities are assets. Call it an asset. If you want to call it your dream, whatever, it's going to get you out of your trailer for the rest of your life, that's cool too. I like trailers, right? So again, we buy every single commodity when it's at the low end of the range and have been doing so since June, with the exception of the month of September, where I did sell my Bitcoin and then I bought it back. Yeah, that was fun. Sold some and bought it back. It's amazing. I must be the only person on Wall Street doing it that way. Bitcoin top end of the risk range, by the way. We publish that daily as well, which you can see, I think, here on our new graphics, but it's called the risk range product. We have a whole new Bitcoin product coming out that's price, volume, volatility, coin volume, everything else that we should be paying attention to, as opposed to people's narratives. I'm long the greatest narrative person, I think, in the market, MSTR, which is Michael Saylor's MicroStrategy. Couldn't run a really good company, but he runs a damn good balance sheet, and that's great. That's been a great holding. 38,739 is top end of the range, so that's where I'd sell some coins. Feed the ducks. And if if that affects you in a certain way, I don't care, because that's what I'm going to do anyway, no matter what you think. All right, let's take some, Neil, we'll go to you, Neil, on what happened yesterday, both contextualizing it in terms of history, but for those of you that don't know Neil Howe, now you know him. He's the guy who was the author of what is called the fourth turning. And the fourth turning, Neil, is when shit hits the fan, and I think that was happening yesterday.
Yeah, that was a mess, wasn't it? And we had a member of my own team, Matthew Ahern, who actually lives only a few blocks from the Capitol. But of course, you know how hard Matthew works, Keith. He didn't even notice. He said there are just a lot of sirens going by.
I've seen that guy. He never leaves the office.
Yeah, nothing would faze him. Anyway, he was deep into his spreadsheets. It was an amazing day, and just to tie it all together, it came right after, of course, the incredible Georgia election. And I mean, look what happened. I think Donald Trump, couldn't stand being a loser, and what was worse, he couldn't stand losing in a state where the two Republicans running for office won. I mean, what would that say about him, right? So, yeah. I think he was happy to see him lose. I mean, I hate to say it. I don't think his heart was in the GOP winning in Georgia. And the turnout showed the Democrats had a much higher turnout, I think particularly driven by Raphael Warnock, just an enormously galvanizing, charismatic candidate. Anyway, they took it. They now, the Democrats now have control of the Senate. They now have control of the entire government in Washington, D.C. So all that occurred on the day before yesterday. and you had look, that was planned in advance. Everyone had planned. All of these Trump activists, I mean, all of these guys, you know, the Proud Boys, the Breitbart people, they all planned to gather in Washington. People didn't see that on Facebook and Twitter, but it was on Parler and Gab and, you know, all the you know, alt sites, all the dark sites. And they gathered, and Trump urged them on, and they broke into the Capitol, and we haven't seen anything like that since you know, Jackson voters stormed the White House, you know, back in I think that was 1828. You know, of course they were drunk. That was a little different, but they were roaring drunk. That was the middle of the Second Awakening, and that was a very interesting time. This is a very different time. But anyway, that's over. I'll tell you, short term, long term. Short term, this spells real trouble for the Republican Party. And I've been talking in the last couple of days to a lot of people about this. I mean, imagine Trump, who's going to want to be a celebrity. I mean, a sort of a permanent, set himself up like a kind of a, I don't know, another Rush Limbaugh out there. I mean, sort of the center of his own party. You can imagine 10 to 15%, let's just say half of Ross Perot's vote in 1992 continues to vote for Trump no matter what. Well, how are the Republicans going to win a national election? I mean, think about that. This is what happened with the Bull Moose Party, you know, back in 1912. This could split the Republicans. How are they either have to completely redefine themselves and pull off a whole chunk of the Democratic electorate, or they could be in a permanent minority situation. So the combination of those two things, and this is one thing too, regarding its impact on the stock market. And I was pointing this out, I think, starting about 2 or 3 months ago. And that is, my theory is that for many, many years, everyone is saying the stock market loves divided government, right? So if a Republican is in the White House, we want, you know, Democrats to be in control of Congress. You know, we don't want government to all be, you know, we don't want government to do anything. We just want gridlock so that markets could flourish. I think after this pandemic crisis, and just given the mood of what's going on in America, I think the markets have changed. I think actually the markets want unified government. We can see that. Take a look at what happened in the SPY, just, you know, and you just look at the mini market, you know, overnight with Georgia and so on. It rallied on the news that we're going to have a one-party government. And I just say this, you know, irrespective of where anyone falls politically, I'm just saying what the market right now wants. How long did we haggle over the second step of stimulus? I mean, that was just ridiculous. I think people are tired of that. So I think that's what's going on. I totally agree with you. So near term, this is very positive for markets, and you just see it. Look, we're going to have a lot more deficit spending. You saw the impact on rates. You know, I don't know what's the 10-year doing. What's the 10-year break even doing right now? But anyway, you can just see rising inflation expectations, rising real interest rates, rising 10-year yield. So you want to be short the long bond, and then obviously you've been calling quad 2 and what's happening in the equity market. So you know the carry trade is on again, right? Everyone's selling volatility when everything looks good for the moment.
Yeah, that's something like a very cyclical, very obvious, I think, to us and any subscriber to HedgeEye. It is quad 2. I guess ultimately I want to just, because I don't have a ton of time, I just want to make sure that people get the context of the fourth turning into what will be this new reality. For a long time, you know, the Fed has struggled to get 2% inflation. We have it going to 3.08% specifically within 3 to 6 months. So you're going to have a lot of that. You're going to have just guys show the inverse correlations between Bitcoin and the dollar, or the, like to your point, S&P 500 and the dollar. What an undivided government says is that if you're going to print money and you're going to spend, you know, as far as the eye can see, and you're going to have a social contract for $15 an hour across the entire edifice of America, you know, the dollar is going to go down, Neil, and it's going to increase the cost of living for the people that could afford it the least right now. Could that be, you know, when we ultimately get the fourth turning is a long-term thing, could that ultimately be fully wrapped with, like you said, a carte blanche for the Democrats to basically keep doing it and doing it and doing it, maybe for the next presidential cycle too. Is that the beginning of the end as the fourth turning would look?
Well, it can go, looking at it right now, can go either two ways. One, you see this regeneration of sort of civic trust in a new sort of ever more dominant Democratic Party working from the middle, working for Biden is, right? Passing these very popular, $15 minimum wage is extremely popular. We just ran a piece on that on Monday, I believe, and I went through the numbers. I mean, it's incredible. It was popular going into the pandemic. It's even more popular now. Florida, 2 Republican senators, 1 Republican governor. They voted for Trump by 3 percentage points, and they voted for a $15 minimum wage by 61%. Keith.
Wow.
This is coming. No, I mean, this is coming. This is here, and it's coming, and we're going to see it. So my point is, you could have that happening. On the other hand, Trump land is out there. You have this large share of voters and a large share of even moderates who look, the Democratic Party itself is kind of a monstrosity right now, right? I mean, they got their moderates, they've got their progressives, they got their really postmodern identity politics people way out there. There are a lot of bits and pieces. They span a lot of different kind of ideologies or sub-ideologies, if you will. They could also fragment. And here we have a scenario that's a lot more like the 1840s and 50s, right? Where we saw first the end of the Whig Party and then the disintegration of the Democratic Party, which kind of went underground for the next 70 years, right? with the reconstruction of the South and all that. But I mean, so that's the other scenario. In other words, the Trump America and those who are disaffected by Democrats who don't belong to Trump, some of them are never Trumpers to begin with, they aren't going to go away either. And I don't know if you saw, but there's an increasing, in Texas, they're always talking about secession. I think they've been doing that for like 10 or 15 years. But there's increasing talk about that. And a number of people, a number of congressmen, it's not just QAnon, it's recession, it's secession. Maybe we should talk about the other Ession word, not recession, but secession. But this is also hovering out there. And what kind of climax, what would it take to push some sort of new middle in America past this? Now, those of you who are familiar with the fourth turning know that this is part of a rhythm of history that arrives about every 80 or 90 years. We've had it, successively in American history ever since the 17th century, and it's here. It's here again. We're seeing it, and we're seeing America run by generations today who have no experience with a civic emergency. We look around, we take everything for granted. And we also have an establishment which is not terribly respected, right? I think it was amazing to see all of these people pushing by the Capitol Police. I don't know if you saw the Capitol Police just get manhandled, and no one really cared about them. I mean, what do they stand for anyway? An establishment that no one respects, not on the left or the right. I mean, no one really respects the kind of the muddy middle in America, right? They're just all these technocrats who keep the Borg moving every day. I mean, who cares about those people, right? There's a great uneasiness in America, and there's, in some ways, I've often discussed this in other contexts, the left and the right cooperate with each other. I mean, both of them want the liberal middle of America to sort of be diminished and to have something bigger take over, right? And this is sometimes called accelerationism. And you see it on both the right and the left. They wish history would move faster and we could get rid of this mushy liberal state which isn't doing anything. Let's mobilize all of America to do something big. Whether it's on the left, a Green New Deal, or whether it's going to make America again. I just think the faith in the middle has been diminished. And that faith, whatever new has to emerge, has to be refounded and re-strengthened. And that's kind of the broader picture here.
That is tight, man, and it's good. You know, from secession to accelerationism, these are not the things that people, Neil, are talking about. And we're out of time here, but thanks for summarizing that. I mean, Neil, talk about having a great teammate. Like, we're looking at the quad, which is the cycle, but we're also looking at all of economic history when we're trying to, tell you what part of the sine curve we're going to go into next. That's all it is. That's all we're doing. And yeah, I got my issues, and I really don't have my politics. I'm not a Republican or Democrat, by the way, and we weren't trying to make any political statement there. We're just trying to let Neil educate you on what's happened historically. And for real, how many of you know what happened in 1828, throughout 1840, through a 70-year sleeping period of the Democratic? Like, who actually knows? I think waking up in the morning, for me, is being aware of what actually happened. Then we could attempt to have an opinion. And that's really what we're trying to do here. So I know we only have a couple minutes here for questions in the queue, Darius, so hopefully we'll have a couple good ones at the top. We always let the viewers rate the questions. So again, typically that can be what's on tilt that morning, what's moving up or down. Those aren't my favorite, but we do answer.
Yeah, absolutely. We're transparent, honest, and accountable. What else can we provide? All right, let's get a few before we wrap up. Sergey from Latvia is the first question. It says the highest rated question, rather. It says Bitcoin is destroying the top end of its range consistently. How can we spot regime change when actually selling at the top end of the risk range proves to be ineffective?
Well, when something goes vertical, like parabolic, so again, don't forget that my model is math-based. It doesn't solve for things that literally go parabolic. So I would probably have trouble with nailing the top end of the range in the tulip bubble, in a lot of different things, when they go absolutely parabolic. What really matters, and everybody knows this that uses the product, is that episodically and non-trending, you do get corrections in Bitcoin when the least amount of people are positioned for it. All right? I don't know if that's going to start happening like this weekend or next week or whatever, but there actually have been multiple times throughout September, actually in particular, and then even in October and then one in November, where you do get the low end of the range. So that's really where you want to know. And if you have a core position in Bitcoin, which I'd absolutely have, all you're really doing with the risk range is selling some. Yeah, I think that a lot of people, Sergey, they still do it like the monkey in the tree. It's like I'm in the tree or I'm out of the tree. I'm all in or I'm all out. That's not how you risk manage money. It's not. And if you don't think that you can do that with Bitcoin, then most of Hedgeye Nation would disagree with you. So again, you sell like 25 basis points or 0.25% of your position, today, because it's at the top end of the range. It's not going to ruin your life, is it? Is it going to get you out of the trailer? I don't know. But I mean, at the end of the day, what it's going to do is it's going to allow you to buy more on whatever day that it is that you get another buying opportunity.
Yeah, and I think it's important to keep in mind everything else that's happening in global macro. We're not supposed to talk about our PAs. I got an email from compliance recently, but hypothetically, if I did have a PA and its biggest position was Bitcoin, hypothetically, how I hypothetically would have done that is whenever the dollar, your dollar signal has been spot on. It's been spot on since 2008. It continues to be spot on in terms of the risk range there. When that's at the low end of the risk range, that's where you could take some, sell some profit, take some profits in Bitcoin. You can gross back up when the dollar has its conniption. Because the dollar is in a structure or in a secular downtrend, we believe. But there's going to be times into some newsy, quad four type market days where the dollar does have a backup.
Yeah, unbeknownst to a lot of people that are just marketing this whole thing with Bitcoin, which is great narrative. Like I said, narrative economics. I started with that. I'm complimenting Saylor. You just understand that the narrative doesn't solve for the risk management problem. Like last I checked, you do need some dollars to be buying some Bitcoin. You weren't just born with X something else to be buying your Bitcoin. You actually have to understand the dollar. If you understand the dollar and you believe that the dollar is going to go away, by the way, I don't think it's going away, but we're short it big time. There's no milkshakes. There's no bullshit. So again, the dollar, you have to understand dollar if you want to understand ultimately what it is. If you don't, then you're just going to be less aware, is what I would say. And when the least amount of people are aware is when there's a risk management moment. I'm not calling for that today in Bitcoin, by the way. It's an interesting question to have at the top of the queue.
Indeed. All right, Chris from Humboldt said, Hedgeye team, thanks for the great start to the year. Thank you, Chris. He says he's been feeding his ducks with so many industrials, financials, and cannabis. He can't tell if they're turning into foie gras or Dave Chappelle. I don't get the latter part, but that's a fun reference. Anyway, I guess Dave Chappelle's getting fat. Anyway, how about an RTA Live soon to help us risk manage these gains? Oh, sorry, it's not really a question.
Well, maybe tomorrow. We've been busy. We got the macro themes deck. Feeding the ducks, for those of you that don't know, that is literally like selling 25 basis points or 0.25% of your position. Feed the ducks. Feed the ducks. Okay? You don't throw a loaf of bread at them. You don't take the whole position out of the tree and throw it at the duck. You're going to not be feeding ducks nicely. You want to sit there. Some people will have a little cocktail, maybe have a little cannabis sitting there on the bench, feeding the ducks in the park. You gotta keep feeding it, right? And then on days where there's time to go buy some more bread, then you go buy it when they're for sale. So again, I know that these things are foreign to a lot of people, but guess what? One guy, he just bought the New York Mets. He does it so well. He trades markets so well. Buys low, sells high. There is a world of hedge funds that do it the way that we do. We called it Hedge Eye for that reason. We want to put an eye or some transparency around what a legitimate and real process is. What you watch, certainly if God forbid if you're watching CNBC all day long, but if you're actually watching something maybe a little bit more technological and engaged like Twitter, you can see that there's a whole community of people that have no fucking idea what they're doing, right? You got a lot of people that you should be picking off while you're feeding the ducks. That's what you want to be doing throughout the day, is educating yourself on the process, understanding where things could be going next, when things are at the top end of the range, the low end of the range, being aware and not the uninformed volume, and then you're just going to do a lot better. I think that the alternative to that is just ignorance and bliss.
Yeah, no, thank you. There's obviously a lot of stuff out there in terms of financial market information, so we appreciate you guys for tuning in this morning. But, we do sometimes get some trolls, which I like sometimes. It's fun to interact with these people. But just as a reminder, obviously you spent a tremendous amount of time, almost a decade or decade plus on the buy side. Your former number 2, my predecessor, is now the CIO of the guy who bought the Mets. So obviously this stuff works, as paper trading obviously works, and,
Yep.
and it's been profitable for a really long time. Let's get a couple more before we wrap up. Jimbo in Kansas is saying, Keith, now that the 10-year has gone above 1%, my experience tells me the chances are greater for it to go to 2 versus back to under 1. Does your math agree?
See, I wouldn't go with your experience. First of all, you don't have a lot of experience with that because the 10-year yield's never gone to 0.5% before. Don't forget that guys, show the yield curve or the 10-year yield. Show the yield curve first, just because I think that's a little bit more instructive for people. So where the yield curve was, take the 10-year yield minus the 2-year yield, and you're inside of 40 basis points wide. It's infrequently that low. From time to time, it would be inverted. But the actual low in the 10-year bond yield, go to the 10-year yield itself, is not ever come from where it's come from. Mm-hmm. So the fact of the matter is that you have no experience with the 10-year yield coming from 0.5% to 1%. Mm-hmm. I just want to make sure that you know that. And I think it's okay. Do you think it's okay that I just criticized you constructively? That is part of the Hedge Eye process. I'm the coach, whether you like it or not. A lot of people don't like me. Guess what? I don't like a lot of coaches that I love. You know that? I want coaches that make me better. I don't want a coach who strokes me when I come into the rink every day. I want the guy, Tim Taylor, who made me go behind the Zamboni and do crossovers to my right in front of the whole team and any girl that was in the building, because the girls would practice after us, and I'd have to look like an idiot going around every frickin' circle until the next practice. All right? So that's what I want in a coach. I want somebody that's going to make me better. So you haven't had any experience with the 10-year yield going from the all-time lows to over 1%. It's new for everybody. It's actually, and the real answer to the question is that you get a power law, or you get in fractal math a move that's more fractal in nature, that no matter what the Fed does, the 10-year yield's going to go up faster at a faster rate, exponentially, power laws, than most people can set themselves up to risk manage that moment. So if you already missed it, you kind of missed it. There are a lot of people that actually blew up this week in the hedge fund community because they're still long duration, long-term bonds, and a deflation portfolio, which would include things like utilities and REITs, which have been god-awful, or gold yesterday for that matter. So you got to be really careful here. Again, it's more about the pace of the move than it is to the specific level of a move. If you're sitting there like, well, my experience says that we go from 1, we go to 2. Well, I mean, Joe Kernan could have said that. It doesn't matter. That had nothing to do with what we're doing every day. What really matters is the specific calibration of where the top end of the range is. Today it's at 107. So most people will believe that they're going to go to 125 because that's the next round number. The fact of the matter is that your treasury shorts are oversold this morning, so you should cover some. And that's another way to think about feeding the ducks.
Cool. Let's get one quick one. I actually accidentally skipped it. Scott from New York is asking, in 2Q21 and 3Q21, the quad estimates point to something that looks like a deep quad 2 and a deep quad 4 respectively. Does that change the preferred investments from a normal quad 2 to 4 environment? It could, but we would have to wait and see for the market signals.
Well, the whole thing about quad 4 is that it happens after you get everything else.
Yeah,
You know
right.
what I mean, so if you go back to the hedge eye process when we made a big quad 4 call in Q4 of 2018, we stayed in it to win it the whole way throughout Q1, Q2, Q3 of September of 2018. Many, many times, people who have incorporated the quads into their process, particularly institutional clients, have tried to front run me and or the quads. It's not about me, it's about the quads. So you can try to get ahead of quad 4. That would mean you're buying treasuries, buying dollars with the milkshake guy. You could have lost. You obviously wouldn't be allowed to manage money if you've been doing that in particular. Those two moves so far for the last 6 months. But this is it's essentially the answer to that question is why we have the show every day, why we have the daily data, why we have the risk ranges is because we don't know. Like, I don't know. It's very typical for me to make a change to the next quad within like a 1 to 3 day window. The 3 days before that, you would have heard me saying the opposite. And you know what? Yeah. Do I care? No. This isn't about the old wall way. Like, well, I think that the top 10 surprises in 2021 are going to be like bullshit. Like, stop. Stop.
No, do not stop that. That's what we're competing against on the bid-ask spread.
Yeah, no,
want them to
real
continue.
money managers across the full investing cycle are the ones that are the best at trading or risk managing the short term of the intermediate to long term. And that's what we're trying to do. And God willing, we'll be 2 feet on the floor. Darius and I both. I need him certainly, and I need him in good health, and the whole team to be able to do that every single day. Without a team, I certainly couldn't do that either.
Yep. Well, thank you, Keith. Thank you guys for joining us this morning. We appreciate you. We'll catch you back here tomorrow, same time. Have a great day out there.
Is the day. Start something new with GoDaddy. Choose a domain that's just right and create the perfect website for you. Find your domain.